Thank you so much. Good afternoon, everyone, and thank you so much for joining us for our kind of annual Fundholders meeting and investment outlook presentation. We enjoy this meeting every year. It gives us a great opportunity to connect with our fundholders to first just extend our sincere appreciation for you being a part of our Community Foundation family, and to give you some information on the funds that are being held and how those are invested, and give you an opportunity to ask any questions of us, and then wrap up with a wonderful presentation by Dr. David Barker. So without further ado, I think we will go ahead and get started, but just want to take a moment to reflect what a difference a month makes around here in Iowa. So it was just a month ago. We just had our second blizzard of the week, and it was feeling pretty frozen and gray around here. And then just a month later, we get all the snow melted and the sun shining, and everyone is feeling optimistic and spring-like. Hopefully that is exactly what the financial markets and investment markets will do for this year as well. So definitely a surprise that you'll see when we dive into our financial information. You know, a year ago at this time, the message was a strong possibility of a downturn and a recession, hold steady with stagnant growth. And as we'll show, we had an investment return of a strong investment return this year. So you just never know what you're going to get. So you never know what you're going to get on the investment performance side or Iowa weather. So we just hold tight to rolling with it, I guess. So with that, I think we'll go ahead and jump in a little bit. So today's presentation is really focused on the investment of endowment funds. And so endowment funds are permanently held funds that are designed to be long-term investable funds that support grant making from them. And those grants can be used to support a nonprofit organization. They can support private philanthropy. So a donor or family could start an endowment fund. Again, the nonprofits, the agency endowment funds are available as well. And so those funds are pooled together. Endowment funds are pooled together for investment and are invested by 4 local financial institutions. And Julie will jump into more of those details for everyone. But before we do jump in, I think the next slide is Julie's. There she is. Hey, Julie.
Hi, I am Julie. Oh,
yeah, welcome, Julie. So Julie is our Vice President of Finance and Operations. It's hard to believe that this fall will be her 3rd year with the Community Foundation. I can't believe how quickly that time has gone. But also on our call today, we have a couple other staff members that I want to just make sure I have an opportunity to welcome to the group. Ellie Moore is managing. Hey, Ellie. Ellie's managing the waiting room for us, but in other days, Ellie is our Vice President of Community Impact. He does all of our grant making work, strategic communications work, and has her hand in just a little bit of everything. We also have a new member of our team on the call today, Ann Barber. Hey, Ann.
hi. Sorry.
Ann is our Director of Philanthropy. So in her role, she is really the open door for any new donor or anyone who's interested in exploring types of funds that we hold here at the Community Foundation. So Ann's a great addition to our team, helping to connect donors who are interested in giving through opportunities through the Community Foundation. And as well, I'm not sure if Cassie Rabishki-Krippis is also on the call. Cassie is our manager of donor services here and just really has a connection to all the funds and all the donors and all of our nonprofits. So we're grateful to have Cassie on our team as well. So I think that's my team, as well as I know I have several board members who were able to jump on too. Nick Hatz, I know you're there somewhere. Hey,
Hello.
Nick. Thanks so much for joining us, Nick. Nick is our chair, our board chair. So it's wonderful to have him on our call as well. So with those introductions, Julie, I'll finally let you take it away.
Thank you, Shelley. I'm going to start off with my slides with a brief introduction of our finance committee. We have Dean Price as our chair, David Bluter, Bart Floyd, Sherry Furman, Todd Jacobson, Redmond Jones II, Jason Wagner, and Mary Westbrook. Our committee meets quarterly, and I feel fortunate to work with this group of community leaders and board members. They have guided me through the last 3 years, and I appreciate all their support and all their input with just our tasks at hand. Our endowed assets, like Shelley said, are spread among 4 different financial institutions that we use: Hills Bank, Midwest One, US Bank, all their wealth management departments, and then United Iowa Financial. Our portfolio managers are important to us, and they are our community partners. And we are fortunate to work with these quality organizations. We recently met with our portfolio managers at our finance committee meeting on January 31st to review performance, investment philosophy, and their thoughts on the economy going forward in 2024. I can say their philosophy and their outlook was quite different than 2023, so it was nice to hear difference. This is our investment performance. Our endowed assets under management as of December 31st were approximately $46 million. This slide shows our investment returns as of December 31st. We ended the 1 year at 16.13. And as Shelley had mentioned at the beginning, what a difference a year makes. We ended the market strong. And 1 year ago, we were at negative 18.21 for 1 year return. So we felt that it was a good year for our market and for our investment pool returns. At the bottom of the slide, I have just, you'll note I have indicated the benchmark and what we use in the percentages of the indexes that we compare it to. And keeping in mind that the performance for our investment pool is reported net of fees. So that takes into consideration the fees and all incomes and distributions going in and out of the fund. My final slide is our asset allocation of our endowed assets. We give our managers broad authority to diversify their portfolios within specific allocation ranges as established by our investment policy, which is shown on the right-hand side. This shows our minimum and maximum targets for each group. Each manager chooses an asset allocation across differing asset classes and to participate in a variety of market sectors and market cycles. At the end of our year, our investment pool allocation was 74% equities, 25% fixed income, and 1% cash. So we ended up, as you can see, our performance was an indication of the asset allocation. So I think that is all I have for my financial reports. And I will turn it over to Ann Barber, our Director of Philanthropy.
It's Julie. I'm just going to talk briefly about the Endow Iowa Tax Credit. This program was started in 2004 with the goals of encouraging charitable giving and also to keep wealth in Iowa. So the way that it works is that any gift made to a qualified endowment held at a community foundation in the state of Iowa is eligible for a 25% tax credit. So obviously this is something that's pretty desirable for donors. It's changed a little bit in the last couple of years. In 2024, there's $6 million allocated for the year in tax credits. There is a maximum of $100,000 per person or $200,000 per couple, and it's available, that $6 million is available on a first come, first served basis. So as of, I believe today, the credits have been available for 1 month. As of today, there's $4.1 million left in credits. We expect those credits to last until probably the middle of the year. So it's advantageous for donors to make their donations to endowment funds toward the beginning of the year if they want to take advantage of those tax credits, especially if it's important to them to get the tax credit in the same tax year that they made their gift. However, you're not out of luck. If you were to make a gift in, say, October of this year, you would still be eligible for a tax credit, but you'd need to apply for that credit in January or the beginning of 2025, and you could get a 2025 tax credit. We help facilitate this process. The applications come through us, and we do not let donors forget that they have this available to them. So sometimes, folks get a little bit nervous about how this all works, but we will help hold your hand through the process and make sure you get the tax credit that might be due to you. Ellie, can you go to the next slide? Perfect, thanks. So this slide is just showing what an endowment fund can do. This endowment funds really have a strong long-term impact. This shows, year one, you start an endowment fund at $10,000. In 50 years, that fund has grown to $57,000, and it's given out $66,000 of grants within the community. So they really have a long-term powerful impact in our community. I think it's on to you, Ellie.
Yes, I'm going to take over quickly just to talk a little bit about our model as a community foundation. So we are one of 17 accredited community foundations across the nation. We all run on a very similar model, but a little bit different. So we are a little bit unique in that we really only serve one county. So we are based here in Johnson County. Everything we do is here in Johnson County, and we're really based in community. So our model is built around community. We invest right here in our county. We have our investment managers that are local, but also our work is being invested here. So this is kind of a cycle, as you can see, of how our work flows. So we start with generous donors like you who start funds with us. Those funds are making grants into the community, but also the fees that we're taking to administer those funds and the grants are being reinvested in our community. So I'll give you some examples here. These are just a few in the last couple of years that we have done. So these are all board-directed grants. We've got a board of about 20 community leaders who help us govern us and make decisions for us. And they have helped us figure out these significant areas of support. So in this kind of slide, you'll see a couple different ways we support. So some of these are grants. So we've made either a significant amount of a grant, so between about $25,000 to $50,000 in support financially to these projects. Or on the flip side of that, we may be a fiscal sponsor for some of these projects. So that is us offering our administrative support to the process. For example, the Child Care Coalition, we are a fiscal sponsor of that. So we're able to provide some administrative support and help get those dollars out to our child care centers across the county. But really kind of overall, these are some big projects that are county-wide. So everything that we're supporting with our dollars and reinvesting is something that's benefiting our county, benefiting all residents here. That's one thing we really look for when we're looking into how we can reinvest funds from the community foundation specifically. So we want you to help us grow. So please connect with our team. You have all of our information. If you want to grow your fund, start a new fund, or if you are looking to make a complex gift, we are happy to help you do that. I'm going to turn it right back over to Shelley so we can intro Dr. David Barker.
Thank you. Great job, Anne, Julie, and Ellie. Each of you add so much to our team, and we're just very fortunate to have them on our team to be able to support the philanthropy happening right here at home in Johnson County. So without further ado, I know the big draw of this presentation is Dr. Barker. But so please know we will have time for questions at the end, questions for us, but also questions for Dr. Barker. But please know if there was any information that you saw that you had questions about that we can dive in a little deeper, by all means, please let us know. So Dr. David Barker. He is a member of the Iowa State Board of Regents and partner in Barker Companies, which owns and manages and develops apartments and other real estate. He has been an adjunct professor at the University of Iowa, at the University of Chicago, teaching real estate investment, urban economics, and corporate finance. Dr. Barker previously was an economist, at the Federal Reserve Bank in New York, where he conducted research on real estate and the banking industry. He holds a bachelor's degree from UC Berkeley and holds a PhD in economics from the University of Chicago. So please welcome Dr. David Barker back again to the Community Foundation investment presentation. Thank you so much.
Well, thank you. It's great to be here. Let me just get this shared. And there we go. All right. Well, thank you. Thanks for that very nice introduction. Nice to see many of you there. Every year I do something a little different, but we'll have, again, a lot of graphs. We'll start out with today's news, and then we'll move on to, sort of looking further back and further forward. But so today's news, yeah, here we go. So today's news was about inflation, right? There was a new consumer price index number that came out. And what I'm showing you on the left is CPI inflation, and those that little upturn there from December to January, that was today's news. That inflation for the month was higher than expected and was an increase in the rate of inflation over December. And you can sort of see how things have evolved over the last several months. That inflation overall seemed to be coming down. Now, what you're seeing here is the overall CPI rate, that's in blue. Then the core CPI, which is consumer price index without food and energy. And then the gray line is services. And then that red line is the goal of the Federal Reserve, which is 2%. So it seemed like inflation was trending downward until we got to October of last year, when it really seemed like we were, hitting that target. And then things started moving up a little bit. And in this, just today, we got the news that it had moved up quite a bit. And so people are unhappy about that, because what it means is that the Federal Reserve will probably not be easing off on interest rates for a while. Now, the chart to the right is a different measure of inflation. And in fact, it's the measure of inflation that the Federal Reserve prefers. And that's PCE inflation. That's the personal consumption expenditure index. So the Fed believes this is maybe a better constructed measure of inflation that they like to gauge and want to put at 2%. But we're sort of seeing the same the same story, right? Even though these numbers are a bit lower than the CPI inflation rate, we're seeing they kind of bottom out this time, maybe in November, and then start moving up. So we're still seeing that upward trend. We don't have January numbers for PCE yet. Those won't come in until the end of February. But that's today's news and what people are excited about today. So what I'll talk about, first of all, yeah, right, it's easier to analyze the past than the future. Very difficult to predict anything, particularly an economy that's made up of people who react to your predictions, right? So that makes it even harder to predict. And as a result, economic forecasts are very inaccurate. As Shelley was saying, This time last year, everyone was expecting a difficult year, but it turned out to be a pretty good year. Now everyone's expecting good times, so maybe that ought to worry us a little bit. But we do know some things. We know a bit about what caused our current problems. And I think the answer is the reason is that we didn't take our foot off the gas soon enough after COVID, right? It was appropriate during COVID when economic activity, came to a halt. When, in other words, the velocity of money got close to zero, and it made sense to inject liquidity to increase the money supply at that time. But the economy rebounded quickly after COVID, and government didn't react as quickly as that. And so we ended up with inflation as a result. And now with inflation, the Fed has to put their foot on the brake, and putting the foot on the brake on an economy creates risk of recession. So current outlook is inflation is down from the peaks, although keep in mind that doesn't mean prices are down. It only means that the rate of increase has slowed, right? Very different thing. Now, of course, some prices are down. There's some commodities and things like that. But in general, prices continue to rise, but not as rapidly. And the Fed's goal is not for prices to come down. It's for prices to start going up at a rate of 2% per year, right? So the rate of increase to slow to 2%. So we've got high interest rates because the Fed is fighting that inflation. We've also got some serious geopolitical risks that could create problems down the road. I probably won't talk about those very much. But then I'll talk about the long-term outlook and some of the factors that I think will be important, in the distant future. One is commercial real estate. There are some serious problems in commercial real estate, particularly in the office sector. We'll also talk about budget deficits, which I've talked about before, but which a problem that is not going away. I'll also talk about population forecasts and some reasons to be optimistic about productivity increases. All right, so just to show about how bad forecasts can be, these charts, I kind of like these sorts of charts where the black line shows what actually happened, and the colored lines show what people were predicting at different points in time. And these are forecasts about a variety of different things. But you can put graphs together like this about all kinds of forecasts, and they are wrong so often. People, predict that things are going to improve faster than they do or slower than they actually do. It's just very hard to get it right. Impossible, perhaps. This is a chart I may have shown last time, but I think it's worth showing again because it illustrates, again, exactly why poor economic forecasts led to the problems we have today, right? The blue line is what I mentioned before, the PCE inflation index. And the gray line is the University of Michigan inflation forecast. It's what people who are surveyed expect inflation to be. All right, so it's regular people's inflation expectations. The orange dots, are the Federal Reserve's predictions of inflation. And as you can see, in late 2020, inflation started coming up. And then shortly after, you can see the gray line starting to come up because regular people were seeing inflation and were starting to worry about inflation. But the Federal Reserve stuck with its forecast of 2%. They were saying, no, any inflation you're seeing is transitory. We're doing things right. Inflation is going to stick at that 2%. And even if it blips up a little, it's going to come right back down to 2%. Well, that didn't happen all through 2021. And they kept their forecast down. They kept increasing the money supply. Ordinary people started seeing inflation, and inflation started taking off. And it wasn't until, really early 2022 that the Federal Reserve kind of figured out what was going on and started hitting the brake. But that was too late because we had already seen some inflation. Now, another point about forecasts, this is the Federal Reserve's DSGE model, dynamic, stochastic, general equilibrium models. And what it shows, the black line is the past, the red line is their median forecast, and the gray area around them is their area of uncertainty. Well, that's a pretty big area of uncertainty, right? I mean, that's not really a very helpful forecast if things can really move around that much. But they're being honest about the state of the art of economic forecasting. In fact, I went to a presentation just last month by the Federal Reserve people who put these models together. I used to work at the New York Fed. This is where it's put together, and they're very direct about the fact that they have gotten things wrong and they will continue to get things wrong. Now, some indicators that we can look at. This is the leading economic indicators that the OECD puts out, and this is for the United States. They move around a lot, but if you move now, you may need to move around the box with people a little bit so that you can see. But this shows the that first of all, this below this red line. When the leading economic indicators get below this red line, we're generally in recession territory. But at the moment, we kind of hit a trough in February of 23, and then those indicators started increasing. We didn't see a recession. These indicators didn't really predict it. So that's something for that measure to show, and that those things below are telling you what those forecasts were. Now, this is a forecasting tool that I may have talked about before that has been a very accurate tool, and that's the difference between short and long Treasury securities, a difference in yield. This is the difference between the 10-year Treasury and the 2-year Treasury. And generally, in most years, the 10-year yields more than the 2-year. In other words, if you're going to lock up your money for 10 years, you want a better return than if you're only locking it up for 2. But there are times when that reverses, when you can get more money by putting your money in short-term CDs, short-term treasuries, than you can in long-term. And usually when that happens, a recession follows. So the gray bars on this chart are recessions as defined by the National Bureau of Economic Research. And the blue line is the difference between the 10-year and the 2-year. And so when that goes below 0, you can see generally there is a recession that comes soon afterwards. Now, this one right before 2020 is maybe kind of lucky for this measure because the COVID really caused the recession, and not anything that you could have predicted by the yield curve differences. But the important thing here is the signal that we're getting now over here on the right-hand side. And that's a flashing red warning of recession, right? That right now, it is still, even though that's eased a little bit, there's a big difference between the 10-year and the 2-year. And that has some forecasters worried. The New York Fed, for example, sees this yield curve inversion as meaning a high chance of a recession. An economist at Duke, who I know, he was a friend of mine in graduate school, Campbell Harvey, he has been an early analyzer of this index and says that the Fed should cut rates now because our risk of recession is growing really rapidly. Actually, when I was at the New York Fed, this forecasting tool was developed actually by my boss. Actually, it was my boss's boss at the New York Fed. And so I spent quite a bit of time looking at his research and thinking about this particular measure. Another private forecaster, David Rosenberg, says that based on some current academic research done by people at the University of Wisconsin, sees an 85% chance of recession based on several measures. Now, this is the New York Fed's recession probability index based on the Treasury yield spread. And you can see over here on the right-hand side, it's showing, again, a very strong recession indicator. Now, that's not always right. You can see in the past, sometimes that spikes up and there's not a recession, but it's a pretty good indicator. This is that Rosenberg forecast that I mentioned, showing that his forecasting measure actually got things right over the last couple of years and was not predicting recession, although he had earlier, but now again flashing that big red warning. So a lot of people are, based on the fact that inflation has been trending down, are optimistic, but that there are others who, based on the way interest rates are aligned, are predicting recession this year. All right, so the big story is inflation, right? So we'll talk about that a little bit. This is just a chart showing the rate of inflation over time going back to the 1990s. And you can see that this inflation spike that we've had over the last couple of years is really pretty significant compared to what we had before. We had inflation back in the 1970s, but it seemed to be under control for a long time, right around that 2% mark that is the goal of the Federal Reserve. So here you can see it definitely got out of control, inflation up to, close to 7% here by this measure. Now, so what happened? Remember, so I said before that the problem was, foot on the gas, foot on the brake sort of issues. This chart shows in blue the unemployment rate, which of course spiked up during COVID, and the Federal Reserve was and the federal government through spending policies was trying to counteract that. So this red line shows the federal deficit. And so the lower that line goes, the more you're pushing down on the gas is the way to think about that, right? It means more of a deficit because that's a negative number. And so the federal government spent a lot more money, spent a lot more than it brought in tax revenue in reaction to COVID, and perfectly appropriate to do that. But you can see unemployment came down pretty rapidly, but that red line stayed very low for quite a while. And even when it comes up, it's still negative, as you can see from that right-hand axis, that we're still running very large deficits, still stimulating the economy that way, although not quite as much as we were. But that stimulus just went on a little too long and sparked that inflation. Another way of looking at that is through the money supply numbers. Again, now here the red line is the unemployment rate. The blue line is the money supply. Money supply went way up, during COVID when unemployment was high, but it kept increasing for quite a while, right? And that's what allowed that inflation to get started. We're now seeing money supply shrink. You can see that blue line is down, and this is the blue line is showing percentage change in the money stock. So we're below zero. So the money supply is contracting, and that's how the Federal Reserve is trying to fight this at the risk of creating a recession. This is something called the Taylor rule. If you're interested, the Taylor rule is a mathematical formula to tell the Federal Reserve where they ought to put interest rates. And what this chart shows is the actual federal funds rate. That's that sort of purplish line here. And these other lines are showing what the Taylor rule says interest rates ought to be, with very different assumptions on the Taylor rule. I saw John Taylor speak last month, and he was not happy about this. He said, look, the model that John Taylor developed was telling them early on that they were making a mistake and they were not increasing interest rates fast enough. And he had been warning that would cause inflation. And sure enough, that's exactly what happened. The Fed just reacting too late. And as a result, here now we're seeing the real interest rate. This is the interest rate minus inflation, which is really what's important for economic decision making. And you can see we're getting up into fairly high real interest rates, higher than they have been since just before the 2008 crash. A little bit worrying to think of it that way. So now there's a lot more on that sort of why in the past higher interest rates have not been as damaging as high interest rates are now. If you're interested, you can look up a whole literature on what's called R star, or the optimal interest rate. So current outlook. Well, so I thought I would just do this by looking at things that have caused recessions in the past and see how they look now. Well, this is overall consumer sentiment that's measured by the University of Michigan, saying just how optimistic people are about the economy. And so when it's down, that's bad, and when it's up, that's good. And so people are still fairly pessimistic about the economy, but it's improving. You can see over the past several months that consumer sentiment has been moving up pretty rapidly and pretty strongly. So that's a good sign, although we're still in kind of negative territory there. This is zooming in on monthly data, recent data, And we saw a spike up in consumer sentiment with the most recent release, although the 3-month moving average, of course, behind that a little. But so that's good news that consumers seem to be feeling better about things. That suggests that we might, have better times. Now, another thing that has caused recession in the past is housing prices. You can see that housing prices, after adjusting for inflation, moved up very strongly in the early 2000s, and then came down, and were part of the reason for triggering the collapse of '08. Here you can see that house prices bottomed out and have been rising, very rapidly. And house prices are now even higher after adjusting for inflation than they were before the 2008 peak. So that's another worrying signal. Although there's some reasons to think this isn't as bad as it was before 2008. Homeowners are not quite as leveraged as they were then. And so people are better able to afford. But with house prices that high, with interest rates high, those payments become less and less affordable. Now, many people locked in interest rates at very low levels, and so their mortgage payments are fine for them. But anyone buying a new house, taking on a new mortgage at these prices and these interest rates can have some difficulties. Let's see. Whoops. What did I do there? I think I shared. Now I must have changed screens or something. What did I do? Sorry, let's see here.
We are seeing the
Right, and I think it's not the right. Okay, here we go. All right. Okay, I'll fix this in just a second. I think I just hit something wrong. And I was here, and move all of you up, and then get it. Okay, there we go. So I was there, and then wait, why did that happen again? There we go. I'll try this. Yeah, here we go. All right. So recessions have also been caused by changes in oil prices. That doesn't seem to be something to worry about at the moment. Here are oil prices adjusted for inflation, and we've been kind of cruising along at kind of about the same level for some years now. Geopolitical risks could change that. Big problems in the Middle East that upset oil supply could, but we produce more of our oil ourselves now, so we're not quite as vulnerable to supply shocks overseas. So again, this is something that has caused recessions in the past that is probably not a major concern now. We also had problems with supply chain interruptions. This is an index from the New York Fed again, showing how efficient the supply chain is. If this number is around 0, that's good, that's normal. When the number goes above, that indicates supply chain problems. And so you can see that index jumping up to unprecedented levels during COVID and the years after, but now really back down to normal. So this is not a big concern any longer about supply chain interruptions. So again, we're getting some good news, some bad news, the way it often is. Another issue is labor supply and whether that might inhibit growth. And you can see here, this is a fairly long-term chart that shows labor force participation increasing as more women came into the workforce, and then has been declining over time since about 2000 or so. And that number has come down quite a bit, went down a lot during COVID, and has recovered from that, but still at low levels. And that's an indicator of the kinds of problems that a lot of us see in our businesses and difficulty in finding workers. Now, this chart, this is a chart of gold prices, another indicator of how worried people are about the economy. We're at elevated levels of gold prices. This is after adjusting for inflation, but no big changes that seem to be going on at the moment. So again, probably not a big warning signal at the moment. All right. So that's kind of our short-term outlook. A little bit about some longer-term potential problems. One, I mentioned commercial real estate. So commercial real estate has been hit in basically, well, I guess 3 ways. You'd have to do 4 ways recently. All right. The most recently is the change in interest rates, right? When interest rates go up, cap rates go up. I see Casey Cook there. Casey, very familiar with all this kind of thinking. But when cap rates go up, that's another way of saying that prices come down. So when interest rates go up, the price of real estate can come down. So all of commercial real estate is being hit by those increases in interest rates. Now, other sectors are being hit in different ways. Retail real estate was certainly hit by the rise of internet competition, but I think that's kind of sorted itself out. A lot of commercial real estate is now with providing services that it's difficult to provide on the internet, haircuts and restaurant meals and other sorts of things like that. So that's kind of balanced out. COVID certainly hit the hotel industry and some other kinds of real estate, but that also has kind of come back to normal. But the office sector is very different. Office was hit hard by COVID, and it has not recovered because people are not coming back into the office. This shows occupancy data on office buildings in different cities based on the cards that people use to swipe their way in. Great source of data. And on low occupancy days, maybe in some cities, maybe a third of the building is occupied. But even on high occupancy days, when the boss says, okay, everybody's got to be in on Wednesdays, we're still only at 50 to 70% occupancy. You walk around the Skywalk in Des Moines and you can see an awful lot of empty offices. And one reason that offices are occupied at all is that companies have long-term leases. And so they pay the rent, whether they have people there or not. So they might as well put some people in. As those leases mature, and then companies may be giving up that space, and we may have a lot more empty office space. This is information on delinquency on commercial mortgages secured by office buildings. While we're not at unprecedented levels yet, that number seems to be rising and might rise a lot more. So that's something that people are worried about as a potential trigger of a recession. If banks start losing a lot of money on these office loans, could cause bigger problems for the economy. Another long-term issue, federal deficit that I mentioned earlier. So this is going back to the 1970s, showing the federal surplus or deficit as a percentage of GDP. And you can see we actually got up to a surplus here, during the late Clinton administration, but we've been moving deeper into deficits ever since. And COVID caused, very large deficits and very large increases to the debt. As a result, this is from the financial report of the United States government, the most recent one issued by the Biden administration, and a quote from that report, probably the important quote from that 1,000-page report is: the current fiscal path is unsustainable. That is a line that has been in that financial report through Democratic and Republican administrations. No Secretary of the Treasury, no economist or very few economists would disagree with that statement. That if we continue on the current path, our current tax code, our current levels of spending, we are in trouble. We're piling on debt, and we can't continue to do that forever. This shows the debt held by the public as a percentage of GDP. If we're forecasting that out for several decades, assuming that policy remains roughly constant, that debt just goes to crazy levels of many multiples of GDP. And no country has been able to withstand levels of debt that high. Another way of looking at it is to see what fraction of spending is going to be taken up by interest, And you can see there that it's a very large percentage, that non-interest spending basically has to stay constant as a fraction of GDP, and total spending increases, all gobbled up by interest. And this is, if you can see, going out, many decades. So this is a, not an immediate problem, but certainly a big potential long-term problem. Another long-term issue is population growth. So we're kind of used to the idea that population grows, but the rate of increase has been slowing, right? The rate of population growth in the world peaked back in 1963. And that rate of population increase has been coming down, but we don't notice that because population is still rising by quite a bit. And in fact, is forecast to continue rising until late in this century, when it is actually forecast to fall. The total world population forecast to fall by late in the century. But that change is not even around the world. So this shows fertility rates by country in the world. Fertility rates below replacement, right? Replacement is 2, below replacement in many countries around the world, but very much above replacement levels in some parts of the world, including sub-Saharan Africa, Afghanistan, and a few other places. If we forecast that out, here's a chart that shows forecast population of Europe and sub-Saharan Africa, where in 1950, sub-Saharan Africa was about half the population of Europe, forecast to be close to 7 times that by the end of the century. Now, looking at China, which has a very low fertility rate, partly as a result of the one-child policy, but partly as a result of trends that a lot of countries are seeing. The projections are for population to fall dramatically from around 1 billion today down to the median forecast, down to below 400 million. Some forecasts down to as low as 200 million. In other words, an 80% decline in population. And that's a new problem, really. Japan is starting to face it. They're seeing lower population. We have seen it in parts of rural Iowa as populations have fallen, as farm work became mechanized and small towns shrunk. But seeing this on an economy-wide level is something that we just haven't dealt with before. Now, my final slide is more optimistic. Now, the population increases you can look at as either optimistic or pessimistic. Population increases cause their own problems, and perhaps population decreases could mitigate some of those. But for an economy that is built on growth, for developers and others who kind of have counted on growth for a long time, dealing with a world without population growth may be very different. Now, this chart is showing something that's a little wacky, right? Kondratyev waves. This is a Russian economist from early in the 20th century that said that there were cycles in economic history, and it's often looked at as a little bit suspect. But there are more economists who are starting to think about this and wondering maybe this isn't so crazy. In fact, I remember years ago, Sarah's professor in business school at the University of Chicago was away for a summer and very graciously gave me his office for the summer. And I noticed on his bookshelf a book about these waves, and I asked him about it, and he said, "Yeah, it's not as crazy as most economists think. There's actually something to it." And I've kind of held that for all these years. So I went back and calculated this the way Kondratyev did. And I took a moving average of stock market returns in the United States, fairly long duration moving averages. And these waves do come out. Now, the reason economists are suspect of this is that you can often take randomly generated data and take moving averages and get it to look like waves. So it is a little suspect, but a lot of these waves coincide with things that make sense. So I used US stock market data back to the 1790s. And before that, I used British GDP growth data. So you see the first peak at about the time that the steam engine is really taking off, right? So the steam engine's invented, starts being widely used, and you see a spike in investment, a spike in returns, and then a decline. Then we see the growth of railroads and the enormous effect that railroads had on the economy. That gives us another spike and then decline. Then another spike that kind of coincides with the peak of electrification and the chemical industry revolutionizing the economy. Then a decline, then an increase at the time that computers, personal computer was developed, and then a decline. And during these declining periods, people tend to say, "Well, boy, we're in for bad times. We've already invented everything that can be invented. What could possibly be next?" Well, now it's AI, right, and more advanced ways of using those computers that we invented decades ago. And it's ChatGPT and other AI applications that might be the beginning of that next wave. And that could solve a lot of the problems that we were talking about, right? It could generate economic growth. That could solve that budget deficit problem by bringing in more revenue. It could solve that population decline problem by doing the work that all those missing workers might have done. So I think that is the biggest cause for optimism at the moment, the enormous improvements that are being made using computer technology, but improvements in productivity of real people. And we're starting to see some of those productivity numbers jump up in some areas, like the food service industry. You walk into a McDonald's, there are fewer people at the counters than there used to be. If you look at call centers, there are fewer people there because AI is starting to take those calls. Enormous increases and people using these tools to make themselves more productive. I use ChatGPT every week for things that Google is bad at searching for, and for helping me to spot problems in code that I write. So all kinds of things happening there. And maybe, even though there are those things I mentioned to worry about, maybe technological improvement, productivity increases are the answer. And that's my presentation. So thanks very much for listening.
Wow, David, thank you so much. That was wonderful, and a lot of really interesting information presented there. I will say it's interesting that you ended on artificial intelligence. I recently watched a program on quantum computing, and I don't really have the capacity to understand all of it, but it was really mind-blowing how, when we think about that message that you just shared, that it's easy to think, well, we've already invented like all of the things. Right now, we are at a point where it's like our computers are turning on and turning off. There's so much more capability using quantum computing that we don't have any idea about.
No, that's very true. And it's a fascinating area. There is growing skepticism about the impact of quantum computing. It has actually been labeled a mirage technology. And in other words, that like you think you see it out there, but the closer you get, the more it recedes, right? Fusion technology is another one that has been labeled a mirage technology. Ever since I was a kid, people have been talking about, oh, fusion is going to power everything, just, in the next decade or so. And it never seems to happen. Quantum computing, fascinating. And there have been some real advances, but not clear when it will actually start having, real life applications. AI, I think, is different. AI, now, for many years, it looked like a mirage technology, right? We kept thinking, oh, someday computers are going to be able to translate languages and are going to be able to chat, with people in ways that seem like real people. And it never really seemed to happen. And it seemed to kind of stall out. But boy, in just the last few years, it has taken off, and its ability to do those things just dramatically. And so the same thing might happen with quantum computing and fusion power. Maybe we'll get to some point, but at the moment, AI seems to be the technology that's really making big changes.
Yeah, it's amazing. Well, I would love to use our time as the remaining time that we have for anyone who has questions. So Ellie, if you can help me keep an eye on if anyone has a question and wants to maybe unmute themselves and ask or put it in the chat. I see Nick's hand first.
Sorry, I might have missed the first part because my house was going crazy at the time. But your last graph, could you just go over again? I thought that was very interesting that it's tied to the technological innovations. But what exactly were the was the graph measuring?
So that graph is it's Kondratiev waves are the idea if you want to Google that. But it's a moving average of stock returns. So you take stock returns. This is over a very long time horizon, and you take moving averages of various lengths to see if you can kind of focus in on waves that make sense. And I was saying that it's suspicious. It's kind of feels like quackery, and I wouldn't want to put too much faith in the idea, but I think it's an interesting way of illustrating what the big things have been in the past that have affected the economy and how it might be affected now. But yeah, it's just a moving average of stock returns, and that long time horizon came from U.S. stock returns back to the 1700s, and before that, economic growth in the UK.
But you're not saying that like on average stock returns get worse after the beginning of that innovation, or are you saying
they reach a peak of when sort of peak investment in those technologies has happened, and then they thought early adopters have bigger returns, and then competition comes in and reduces those returns, and so yes, eventually when a new innovation really starts kicking in, you see high returns, and then those returns decline.
Gotcha. Thank you.
Sure.
I think there was a question in the chat.
Oh, yes, I see that from Kelly.
Yes.
How worrisome is record credit card debt? Absolutely. Another signal of potential issues. That's, everyone talks about how, it's the strength of the consumer that's keeping the economy going. Well, unfortunately, the strength of that consumer is coming in part from debt, and that's not sustainable. So that can't continue to increase without causing problems. So yes, I think it's worrisome, particularly worrisome if you start seeing delinquency rates move up. And I think there's some evidence of that. I think auto loans delinquency rates are starting to tick up a bit. I think not a giant red flag at the moment, but certainly something to worry about.
Other questions?
Oh, looks like Casey.
Yeah. Casey, you're muted.
Yeah.
Oh, there you go.
So David, this is a question I ask yearly. What are you doing with your money this year?
Retail real estate. I love, Sarah and I, we love apartments, but they're still expensive. I think because the prospects for the apartment industry are good, but they're expensive, particularly with interest rates, as high as they are. We don't like office, and we've got our hands full with hotels. But that retail real estate seems to be in somewhat short supply, and we can find cap rates that are higher than current interest rates on some properties that we like. We feel like the tenants that are vulnerable to internet competition have already gone bankrupt, and so the people who are left have figured out a way to deal with that. And when our tenants leases come up for renewal and we raise the rents, they get upset and they say they're going to move, and then they look around and they find they can't find anything better, and they come back. So for the moment, that's the sector that I like. Oh, I see.
Sarah, yes, please.
So David, explain what you mean by retail real estate, because what we're looking at is a certain sector that seems to work. It's local, it's smaller.
Yeah,
It was
strip,
selling out.
right, strip shopping centers, with that you see by the side of the highway.
Taco Bells and Dollar
Right.
Tree.
Right, not the big shopping malls, not the big enclosed shopping malls, which are still in decline. But yeah, just that ordinary, daily kind of shopping centers. Grocery anchored shopping centers are great.
Hardware
That's
stores.
Yep, yep, exactly. We still we're still invested in the pawn industry. Also, we still like that.
Can I ask one more question?
Sure.
Do you, I see, your comment on the office market, especially in downtowns. I see that as well when I walk through the Cedar Rapids Skywalk, and it's just like it's like, how is there this much infrastructure with nobody there all the time? And I guess, housing conversions of office space. I just am curious your take on if you think that will ever become prevalent in a meaningful way.
Yeah, Sarah and I have been to a couple of presentations on that. And in fact, we owned a building in Moline that was an office building that was converted to apartments. So it is a solution for some buildings, but I think the estimates are only 10 or 20% of office buildings are really conducive to residential conversion. Those big buildings with big footprints and a lot of interior space, that's pretty hard to turn into an apartment when there are no windows. It's the older buildings when they used to think about light and air circulation instead of sticking everyone in cubicles, with air conditioning that are the easiest to convert. But it's expensive. I mean, bringing in the plumbing that you need and that sort of thing is very expensive. So it's not going to be the solution. It's a solution kind of on the margin, I think. In fact, I don't know that there is a solution. A lot of real estate gluts we have grown our way out of in the past. I don't know that we'll grow our way out of this one. There might be a lot of office buildings that get demolished eventually.
It'll be interesting.
Yeah, fascinating.
And it's a problem with real estate. That's one of the reasons that real estate is fundamentally different than other goods and services, because once you produce it, it lasts a long time, right? If you produce too many tomatoes, not a big deal. They're going to rot and you'll get back to equilibrium quickly. If you build too much real estate, it takes a long time to get back to equilibrium.
Yeah, I've often thought about, the price of real estate, as your graphs mentioned, how much the price of real estate has gone up. And also with interest rates being so high, many people are staying put.
Yes. And
how that will sort of feed the vicious cycle of increased real estate prices, because if there aren't as many homes for sale, then obviously it's a seller's market, actually.
That's a very good point. And, mobility is important for an economy. When there are opportunities in some parts of the country and not in others, it's important that people move to take advantage of them. But high interest rates and a rapid increase in interest rates, as you said, locks people in. And so they don't move. And in fact, our mobility rates have declined a lot. They've been declining for some time, but they're declining a lot now because nobody wants to move and give up that 3% mortgage. And there are also other fundamental drivers of housing demand that just the opposite of what's happening to office. People are working from home, so they want a bigger house, right? You need an extra bedroom to do Zoom calls. So that demand is increasing. Supply is not increasing fast enough.
I'm getting to a point in my life where I'm also starting to think that I'm going to need an extra bedroom, because that college student who is graduating is not going to be able to afford his own home and is going to be living at home with us.
Right.
We'll see.
Right. Well, that demand will probably continue increasing for a while. But again, if those population trends eventually kick in, then we're going to see declining demand for all kinds of real estate. And now this is in the very long term.
Right. Fascinating. Casey, did you have another question?
So the fact that there isn't much mobility in the single family home market, doesn't that benefit rental apartments and whatnot, David? I mean, in Iowa City, our study just showed that with the exception of a few, 5 and 4 bedroom things, vacancy rates are, despite all the building that's been going on, vacancy rates are huge, or they're very small, I should say.
Yep. Yep.
But I asked in University Heights for the older houses, and there's like 250 of them that are rented. It's about a 12% vacancy for the older stuff, which surprised the hell out of me. But anyway, I think it's a good thing for apartments right now. High interest rates.
Yes. Yeah, absolutely. That's one of the nice things about the apartment business is that there's a natural hedge with interest rates. When interest rates are low, you take advantage by refinancing your property as an investor. But when rates are high, the fundamental demand for your product is high because it's harder for people to afford houses, and so they rent apartments. So you kind of, it balances out. But yes, the apartments are doing well. Sarah and I were just at an apartment conference in San Diego, and the mood there was very positive, except for worries about regulation, in particular rent control, which has been gaining around the country and is causing some worries about whether this will inhibit new supply and cause problems for the efficiency of the market overall.
Thank you.
Sure.
Interesting. Well, if there are no other questions, I think we will wrap up our time together. Naively, I go to Dr. Barker each year and graciously ask if he would be willing to, could you be on a Zoom call for 1 hour with us? And of course, he's so gracious of his time. But as you can tell by the slides and the graphs, how much, it's not lost on us how much time and preparation you put into that presentation. So thank you very, very much. And as was kind of alluded to, so Sarah Richardson and David Barker are husband and wife. And so you can imagine the very engaging and stimulated conversations around the dinner table that these two have on a regular basis when they are together in the same place and not in different parts around the country. So thank you both for your participation today. We certainly appreciate it.
Oh, thank you. Enjoyed it.
Thank you.
And as always, if there's anything that the Community Foundation can do to support your charitable giving or support your nonprofit organization serving our area, please reach out and let us know where it would be a real honor to assist you, as always. Great. Well, get out there and enjoy this beautiful February evening. Take care, everyone. Thank you so much.